Most physicians understand real estate builds wealth, but they miss the power of diversified fund structures. Our latest diversified multi-asset fund has 7 to 8% cash flow day one and a projected 2.5 to 3.5x multiple because not everyone fits the box of single asset multifamily value add and 5-year holds. This fund lowers risk in your portfolio while bringing you the returns, tax efficiencies, and cash flow you need. Hi, I'm Param and I retired from full-time medicine at 41 through cash-flowing real estate. Now I help physicians access the same deals I personally leverage through GW Capital, and our latest opportunity is a diversified fund of 20-plus manufactured housing communities and self-storage facilities across multiple markets. And we're welcoming accredited investors to join us in this offering. With strong day one performance, I told you it's already cash-flowing at 7 to 8% with projected 15 to 20% annualized returns. And you get greater than 120% depreciation tax losses over 3 years. These are historically resilient, needs-based sectors with multi-state diversification. You've earned your accredited status. Now build wealth like one. To learn more about the full deal structure, the numbers, and tax benefits, go to gwcapital.com/MHPFund1. That's the number 1 in lowercase.
Super excited to deep dive into today's topic, which is year-end tax moves. And I have with me Nick, who happens to be my CPA, and I worked with Nick and his team for many years now. This is a question at end of the year, especially after you're done with last year's taxes. That's usually when a lot of us start focusing on what we can do to minimize taxes this year. And there are a few weeks left in the year, and a lot of you have been asking the same question: what can I do now if I really want to be tax efficient? And so Nick and I I'm super excited to have him on here. Nick is a real estate focused CPA. He has a virtual team that works with clients, high net worth individuals and real estate investors across the country. He also owns his own real estate portfolio, including short-term rentals, which I think allows him to bring unique insights to the community. So I'm super excited to be doing this episode with him. We will be talking about if you don't currently own real estate, we want to make sure this is super beneficial to everyone. So if you're someone who hasn't invested in real estate at all, we'll have strategies that are not real estate specific. We'll have strategies that work for people who invest passively in real estate. We will be talking also about more aggressive tax strategies that you can use to shelter your W-2 income from taxes if you're a real estate investor or if you're just getting started. So lots of cool stuff. And on the back end, we are going to talk about like a strategy that I learned this year. And I don't learn a lot of new things every year, but I was excited when I learned about this. And the interesting thing is we have a lot of investors in our community come and ask questions about this. So stay tuned, stay with us till the end.
Welcome to Generational Wealth MD's podcast on financial freedom through investing in real estate. My name is Param. I'm a mom, radiologist, real estate investor, and mentor to others looking to start or scale their real estate portfolios. The goal of this podcast is to provide you with inspiration, strategies, and insight so that you can stop trading your time for money and live life on your terms. If you love the episode, don't forget to subscribe and leave a review.
And with that being said, let's get started. Nick, thank you so much for doing this.
Thank you so much for having me. Yeah, and I love, just to preface, I love working with you and I love how knowledgeable you are, and everybody that we work with from your community also the same way, very knowledgeable and willing to learn, willing to invest. That's really important because that's really the first hurdle to clear to being a successful investor is the willingness and the want to learn and to grow. So that's what we'll be doing today. We'll talk about some advanced tax strategy. I know, Param, like you said, we're only a couple weeks away from the end of the year. So we'll talk about what we can fit in, but also big picture stuff, generally, what we can do. Keep me honest on time. I can talk about this stuff all day. So if I need to speed up or slow down, just let me know. But since we're so close to the end of the year, I figured I'd like to start with some passive tax conversation because really income falls into two buckets mainly, passive and non-passive. And that dictates how that income or those losses affect your tax liability on your tax return. Usually they don't mix. Can't take passive losses and offset non-passive income. So we want to make sure that income is classified correctly and we know which source of income you're receiving and how to offset that. So items like W-2 income or K-1 income if you're a partner or shareholder in a partnership or corporation, or 1099 income if you're self-employed. Those are all non-passive forms of income. Passive income could be real estate. It could be an LP investment in a syndication or any kind of passive activity or passive investment in an activity that you don't materially participate in. Those are passive investments. And this year, I mean, towards the end of the year, there really isn't enough time left now to get into an investment or a business that requires you to materially participate, meaning spend a certain amount of hours throughout the year, because it's so close to the end of the year. There just isn't enough time to find, acquire, participate, place in service, get renters, or, do all, it takes time. So when we're this close to the end of the year, we focus on that passive a lot of the time. And that passive bucket, if you have passive income on your return, maybe you're a limited partner in a syndication or private equity fund or some other investment that had an exit this year, or maybe it has just steady streams of income, taxable income passed out to you each year in a K-1. Maybe you're a fractional owner in a surgical center, or you have an investment with an acquaintance or a family member, and you provide the financial capital to make the investment and they do the work. That would be passive income to you. So maybe you have some passive income somewhere on the return, or you're just looking to put money to work for you and don't want taxable income to come back. You want tax-free income to come back to you. Passive opportunities are a great way to do that. And where we first start and where we look first to generate passive losses to help offset passive income or to help protect passive income is real estate. Is real estate. So you can invest in opportunities without having to manage the property day to day, without having to be involved in the operations. You fund the acquisition, or at least a part of it. And in return, you gain a percentage ownership of the underlying asset, and you are a part owner of an asset that might do X amount in losses in the given tax year. Because when you acquire real estate, that first year that you buy the real estate is really a powerful tax reduction strategy year. When you place the property in service, you can do what's called a cost segregation. We can probably talk a half hour or more on cost segregation alone, but the cost seg, which you guys may have heard of or learned about already, is a way to just accelerate your depreciation on the acquisition. And that could happen. That happens at the property level, at the partnership level, and that trickles down to all partners. So you, as a limited partner in a passive opportunity, you put in X amount, and you might get 40%. I'm pulling this number out of thin air, but you might get 40% of your initial investment back to you as a loss on your K-1 that you can report in your tax return to help reduce passive income. That's a really significant benefit. And it's something that all you have to do is wire the money. Of course, do your due diligence and understand the investment you're getting in. You be comfortable with the investment. You want a good investment first. But assuming that you check those boxes, it's a great tax benefit without you having to really lift a finger, other than simply funding the opportunity. So I like that when we're close to the end of the year, if you have some passive income, or if you know you're going to have passive income next year, because that carries over indefinitely. You can take the loss now. You may not be able to use it now, but those suspended passive losses carry over indefinitely until you do have passive income. And that could be useful if you know you're going to maybe there's an exit coming, or maybe you have a long-term rental property that you own and you want to sell it because it isn't performing the way you expected, and there's going to be some kind of passive income in your future. You can carry forward those losses and offset it next year. So really positions you to have some flexibility from a tax planning standpoint. So I like when we're this close to the end of the year, it's an easy way just to put some money to work for you and not pay tax on any distributions you might receive, although you probably won't get distributions before the end of the year, but put some money to work for you while securing yourself some either immediate or future tax benefit.
Love that. Nick, do you want me to I'll take a beat. I'm sure a lot of you are thinking, okay, how do I make sure this works for my personal situation? Or if I want to talk to Nick and his team, how do I connect with them? I'm just going to drop the, the link in here. Guys, if you want to connect with Nick and his team, go to generationalwealthmd.com/CPA in lowercase, and you can have an introductory call and you can talk to him and see how they can help you strategize, especially so since we're close to the end of the year, and I'm assuming people can still engage you for 2025 tax taxes, Nick? That's still an option.
Absolutely.
Okay, perfect.
Yeah, absolutely.
So, guys, and I think I always tell this, I tell people this tax planning and tax preparation are two different things. And so, if you want to plan and you want to make sure you're engaging Nick's team to assist you with 25 taxes, then this is time sensitive also, right? When we talk about end of year moves, this is probably one of the most important ones you can do. So, go to generationalwealthmd.com/CPA in lowercase. Make sure, you connect with his team and see if it's a good fit and start strategizing. So, that's important. And like Nick mentioned, like he went into like the strategy he was talking about over here in terms of getting into passive real estate investments and tapping into those tax efficiencies. That's something that's open to all of us, right? And like he said, you need to do a little bit of due diligence, and we have a ton of resources for you guys. If you haven't downloaded our free guide for people who are investing passively in real estate, that's gwcapital.com/guide in lowercase. Kind of talks to you about things, so you go in knowing what you're doing, so you're doing your own due diligence, right? And like Nick said, that is a really important piece. You need to know what you're doing. And if you're looking for an opportunity before the end of the year, and which is why I'm excited when we have end of the year opportunities, because you get a flood of soft commits, a lot of people interested, because everyone is like, and it happens to me too, right? Last minute I'm like, okay, what are my numbers? How much do I need to invest to make sure I'm being tax efficient? We have an opportunity right now, and the last day to soft commit is tomorrow, so make sure you're at least going reviewing it and putting your non-binding soft commit in, so you have a spot and you can do your due diligence. You can hop on a call with the team. But that's gwcapital.com/mhp fund one, the number one, all in lowercase. What I love about this opportunity is that we're talking about taxes. This is an opportunity where the tax losses that Nick was talking about, you get about 120% depreciation losses over 3 years, right? And so you get to use that towards the distributions that you're getting, like Nick was saying, which means that you have cash hitting your bank account every quarter from cash flow, and that's tax efficient. You aren't paying, you're deferring paying taxes on it. And hopefully we have time to talk about like back end strategy and how you can, keep deferring having to pay taxes on the income that you get from these opportunities and from the capital gains on the back end as you get the profits. But this is a great opportunity, 7 to 8% cash flow day one, projected 15 to 20% IRR, and then the tax losses, over 120% tax losses over 3 years, right? So a lot of interesting stuff. Go check it out. It's gwcapital.com/mhp fund one, the number one, all lowercase. And like Nick said, it's an easy thing any of us can get into to lock in those end of year opportunities. Is probably one of the biggest things we will have. Everything else is strategic, and we will deep dive into it. But Nick, back to you. I could go on and on about this, but back to you. Let's move on to maybe the next thing. Well, I want to step back one second. Now, Nick mentioned a lot of different ways you have passive income, right? And if you've hopped on calls with me, and when you hop on a call with Nick, this is a lot of strategizing that we will do with you. But even if you're listening to this episode, this is something you should know, right? What passive income generators do you have, right? That is rental income. This could be income coming from businesses that you are not materially participating in, that are sitting on the passive side. Do you have gains from selling real estate? So what is it that you're trying to offset on the passive bucket, and what you can do that helps you strategize around, okay, how much do I need to invest and how you can be tax efficient? So make sure you're taking note of what your passive income generators are each year. And some of that is getting offset by depreciation, but what are you actually, how much are you paying taxes on, right? Because those taxes, you're paying marginal taxes again. What are your capital gains? So know that, and that helps you strategize around all these tax efficiencies in the passive bucket. But that being said, over to you, Nick.
Yeah, absolutely. And just to piggyback off that, how to plan for that is proactively. The only way to do that is proactively. When you invest passively, you do relinquish control. That's the trade-off. Passive investments are great because you get to sit back and collect your quarterly check, and eventually, when the opportunity exits, hopefully some more at the end too. The trade-off is that you don't control the exit, you don't control the day-to-day operations. You're truly passive. So while you're maybe not in control of the actual management of the ongoing activities of the property, you're still informed. You're still informed, so you know how the property is performing. You should know reasonably in communication with the sponsors when there might be an exit opportunity, when there might be a refinance or a sale, and that's when you get your windfall and potential tax liability increase, because there's going to be a gain to you. But that's what I love about real estate, is because it offers flexible exits. So you have these passive buckets where you can stagger your syndicated investments, and you know you're going to get an exit this year. Maybe you make another syndicated investment to offset that. And it can be really flexible. But moving on to like the non-passive bucket too, that's important as well, because you can now, it's like I said, it's a fork in the road, one of two ways. The second way, the non-passive way, you can start to trickle losses into other areas of your tax return. That's where you offset W-2 income, and that's where you offset non-passive income. And while there typically isn't enough time to do that this close to the end of the year, it is something to bank and then think about how you might want to approach that next year. And that could be also, you can do that with rental property investing. However, for most people who have full-time job or even part-time, it's difficult to do real estate professional status, which requires you to spend more than half of your time in real estate and over 750 hours in the year. That's a lot of time. So when you're working, whether it's zero point 0.5 or more, it's really difficult to spend more than that in real estate unless you have a wide portfolio, unless you have rentals that you're spending a lot of time on actively renovating yourself or doing repairs. It's really difficult. Not impossible, but difficult. So we see a lot of short-term rental investing for non-passive and people who are working and want some non-passive tax losses. They target short-term rental investing because the requirements to make that non-passive are much less intense than real estate professional. You can do it with a full-time job. Basically, you just need to materially participate, and that's a long conversation. So material participation basically means you have to hit a certain number of hours for the year in order to qualify, and you have to keep the average length of stay to 7 days or less. So a short-term rental, almost like you're operating a hotel. And that would give you non-passive status. And then you do the same strategies that we just talked about with passive investing in a syndication, for example. Cost segregation, bonus depreciation, accelerating your non-cash deductions, because depreciation is a non-cash deduction. When you buy the rental property, depreciation is calculated on the full value of the purchase price. Even if you only put a percentage down and you fund the rest with the mortgage, you're still getting the benefit calculated on the full value. That's really where the benefit is coming from. So depreciation is telling you that you can deduct that purchase price over a certain amount of time as defined by the IRS. For short-term rentals, that's 39 years. For long-term rentals, that's 27 and a half years. That applies to if you own the property directly or if you're a 0.5% owner in a syndicated apartment building. It's the same class life for residential and non-residential real estate. So that's a long time. Recovering that benefit over 3 or 4 decades is a really long time. So we want to accelerate that as much as possible. How do we move up that depreciation and get you as much of that as possible now? Because it's a non-cash deduction. You don't pay for it. It's a tax adjustment. So to reduce your taxable income without having you to spend the money, without having you be required to spend the money to get that reduction is extremely valuable. You keep the cash in your pocket, you get the tax write-off, and you recycle the tax savings. That's really a key to scaling your portfolio and leveraging the growth of your investments. And that's what this strategy does. And you can copy and paste that idea across other areas of investment as well. I'm sure you guys are familiar with, you've probably seen on social media or talked about this yourselves, but buying vehicles, for example, is another way to do that. Now you have to be careful with how you purchase and use vehicles for business purposes. But assuming you meet the criteria to make it a business vehicle, you track enough miles to make it a business vehicle, it reaches, meets the criteria to be bonus depreciable over 6,000 pounds. And
I just want to interrupt because I feel
sure.
compelled to say this could mean a Tesla Model X. This could be there are certain BMWs, I think it's an X7 and a Q7, I believe, that qualify, right? So there are certain criteria that need to be met. But sorry, go ahead, Nick.
Exactly. Certain criteria need to be met. If you want a pickup truck, the bed length has to be over 6 feet. So there's certain criteria depending on the vehicle you want. But it's the same concept. If you go buy a vehicle that's $50,000 and you put 5,000 down and finance the rest, if it's a 100% business use vehicle and qualifies for bonus depreciation, you can write off the entire $50,000 on your taxes. It's the same concept, non-cash deductions, because you're only paying this amount, you're financing the bigger amount, but you're still getting the write-off on the whole purchase price. So there's different strategies with vehicles. If you have a business, if you have a W-2, realistically, you won't be able to use a business vehicle. You won't be able to write it off against anything because a W-2 isn't business.
Correct.
If you have 1099 income or K1, or if you have a rental property, or if you don't have any of that and you're okay with making the vehicle the business itself, you can purchase the vehicle and rent the vehicle out, and make the vehicle the business asset. On an app like you would rent a short-term rental on Airbnb, you would rent a vehicle on Turo or a similar platform. So you can make the vehicle itself a business. A business doesn't have to attach to another business that you may or may not have. And that's a
Nick, I
good
love that.
strategy
I mean,
towards the end of
actually,
the
I don't think
year.
we've talked about that anytime recently, but that's an amazing strategy. Right now, you have a
Yeah.
vehicle and so the concept of leverage and combining that with the depreciation losses is amazing, which is what Nick is trying to highlight, which means you could put 5,000 down to get a $50,000 tax loss that you can get before the end of the year, right? So that's super beneficial. It's similar to what we do in short-term rentals, where you can put 10% down, right, and depreciate, all the entire depreciable basis, which has a useful life less than 20 years. But again, that starts becoming powerful, which in short-term rentals you can get close to getting infinite return. So you can potentially, if done right, pull out all the capital that you have in the property, or if you do it with a business vehicle, like Nick is talking about, like, I mean, that's a powerful strategy that you still have time to do if that's what you want to do. So sorry for interrupting. Go ahead, Nick.
Yeah, no, please, anytime. I really want to highlight how we approach advisory, because it's really a cornerstone of like our values as tax advisors. When we look to make strategic advice, when we look to make strategic advice, we want to make sure that we're doing so in a way that is protecting your cash. Like, we never really recommend you to spend money for the purposes of saving taxes. If you didn't need a vehicle, I wouldn't recommend buying one, spending $50,000 on a vehicle. And if let's say you're in California, top tax bracket, you're paying 50% in taxes. If you buy a $50,000 vehicle in all cash and you get a $50,000 write-off, it's saving you $25,000 in taxes. But at the end of the day, you're still out $25,000 economically, and for
Yes.
something you didn't need. So when you buy a vehicle for something that you need, of course, that's different. But to make the vehicle the business itself, it's now an investment. That vehicle should cover its own cost, hopefully return some cash flow to you, while simultaneously getting you a meaningful tax deduction in that first year. Those are the types of investments that we look for, which is
Was
why
it
real estate's so
shit?
powerful too.
Was it Schitt's Creek, Nick, where there's this little piece where the kid goes, okay, this is a tax deduction, this is a tax deduction, that is not a tax deduction.
Yeah,
You're actually
yeah,
spending
right.
money on things.
He
So
didn't,
you
I
really need
remember
to
that. He
be,
didn't
yeah,
know what
you
a
need
tax
to be,
deduction was. Yeah,
right.
exactly.
You
Big
need to be
write-off.
intentional about it, right? If you're doing it for something that generates income, right, that's an investment.
Yeah,
That's important, and you need to realize that, be intentional about that, and don't let the tax tail wag the dog. Is essentially what Nick is
absolutely.
saying.
Yeah, and I want to make something clear too with the vehicles, 'cause I don't want anyone to run off to the dealership after this webinar and go buy a car, because we're a couple days from the end of the year. But if you make it 100% business use, that's fine for the end of this year. However, you need to keep the business use tracked by mileage. You need to keep the business use over 50% for 5 years to avoid recapturing that depreciation. You can't buy a vehicle now, use it for 2 trips, and say it's 100% business, and then turn that into your personal vehicle next
Yes.
year. Wouldn't work. The IRS has this rule in place to avoid exactly that. So it has to be over 50% business use based on mileage for at least 5 years. Otherwise, you'll have to recapture some of the depreciation. So that's one caveat with the vehicles, but still a great strategy. And just, that's another example, real estate, vehicles. And then you can extend that to other areas of investment as well. We've seen people do this with ATM businesses, landscaping businesses, laundromats, car washes, gas stations. There's no shortage of investments you can make that have depreciable assets that you're acquiring, that follow the same principle. Leverage the purchase, depreciate assets, and accelerate that non-cash deduction. However, with all of these things that we're talking about here, you need material participation.
Material
You have to spend
participation.
a certain amount of time given in the year to be able to qualify for it. But very powerful strategy if you have the time to do that.
If you're interested in learning how to invest in long-term and short-term rentals the right way, so you can accelerate to financial independence with the support of mentorship, community, and vetted investor agents in strong markets across the country, then get on the waitlist for the next cohort of Creating Generational Freedom at www.generationalwealthmd.com. You don't have to learn from decades of costly mistakes by yourself. The program is only open for enrollment in the spring and fall each year. In the last 6 months alone, our members have acquired over $60 million of real estate, and more importantly, they're living life and practicing medicine on their terms. You don't have to do it alone.
Nick, now you talked about quite a few things, right? And I know both of us are rushing to get in all the strategies before, in a timely manner. But you talked specifically about, the real estate professional status, short-term rentals, right? And something we didn't touch upon was medical office buildings. Again, these are all strategies where it allows you to take losses, your depreciation losses against earned income, right? In the active bucket against W-2 income. And so if you're trying to plan for this, something you can do, I would call this a year-end move, is if you want to learn more about this so you can strategize around this for 2026, then a resource I want to offer is the waitlist to our coaching program, which is where physicians like you go through training, you have community, you have content, you have access to realtors, and you're actually learning to do this in an educated manner. You know to buy profitable properties and how you can tap into these tax strategies. And so if you're considering doing this, then get onto generationalwealthmd.com/waitlist in lowercase, so you're notified the next time the program opens up. We have students who are doing this. We have students who've acquired medical office buildings that they have their practices in, sheltered $800,000 of clinical income from taxes in 1 year, right? So when done right, this is a very powerful strategy. Same thing with real estate professional status and short-term rentals. You could buy properties and use leverage and generate significant tax losses, but this is the time to start learning about it so you can do this for 2026. And Nick also highlighted non-real estate strategies where you can do this with business vehicles using leverage, businesses that you're materially participating in. Again, this is a great time to start learning about that if you want to do that for 2026. I wanted to talk about exits on the back end, Nick. What I hear sometimes,
Sure.
which I think was very interesting for me, and I don't know if you've heard this. Sometimes people come into the real estate ecosystem and we talk about tax strategies and they feel like, okay, you have it on the front end, but you're recapturing it on the back end. So what's the whole point if you are recapturing it on the back end? And it blows people's minds sometimes to realize that you potentially never have to recapture those taxes. Can we talk a little bit about back end exits and how to be tax efficient and maybe even step up in basis? Very briefly, because I feel like I'm throwing you off tangent because it's not really your end, but just like a real quick information for people who are listening.
Yeah, there are a bunch of ways to exit real estate cleanly or defer the tax. Deferring tax and avoiding tax are two different things. Deferring tax, you're kicking the can down the road to be realized later, possibly. There are ways you can defer it indefinitely, eventually, ways that it can go away. And then there are ways to avoid tax, just completely extinguish it. So yeah, exit real estate offers great amount of exit benefits because it produces capital gain and it produces recapture. But you can defer both of those in a 1031 exchange. That's one example. You can do an opportunity zone investment. Although we're in a very weird time with opportunity zones right now. 2026 is going to be like a dead zone for opportunity zones, but it'll revitalize in 2027. So that'll come back. So opportunity zones is another good way to defer capital gains. Installment sales are great. You can, for what I love about real estate exits, there's a 1031 and there's something that we call the lazy 1031, which
While
is,
we're talking about that, because there are lots of questions around that.
yeah, which is basically like, a 1031 exchange, you have to go through a very procedural and strict process. You hire a qualified intermediary. You have to identify a replacement property within 45 days of selling your property, and close on the replacement property within 180 days of selling the property. So the timeline can be tight, and depending on the climate and the market that you invest in, it could be really hard to succeed in the 1031 exchange to pass. So if you don't want the pressure of having like a 6 month timeline, if you're doing this in the beginning of the year and you're selling your property early, you can extend that timeline by doing what we call a lazy 1031 exchange. And that's basically selling the property outright and then buying a new property in the same tax year, because you can do things like cost segregation and generate losses from that new property that can offset the gain in a separate area of the tax return, but accomplish the same thing. It accomplishes the same thing. At 1031, you're deferring the tax, but a lazy 1031, you're increasing your income and you're decreasing income in another spot, and you're washing it out essentially the same way. And I actually like that better, not only because of the additional timeline, but because when you sell a property and you recognize that gain on the return, you're paying, especially if you held it longer than a year, you're paying long-term capital gains. And even the depreciation recapture on Section 1250 property is capped at 25%. So at a max, you're paying 25%. At a max long-term capital gains, you're paying 20%. If you're a high income individual in a high tax state, that's pretty favorable. So we would put that gain on one section of the return and understand that we're recognizing that gain. And if you buy another property and that creates losses that you can offset, those losses actually offset your ordinary income first. So if you have high W-2 income or high K-1 income or high 1099 income, you have a $100,000 capital gain and a $100,000 loss from your newest real estate acquisition. That $100,000 capital gain is going to be taxed at 25%, but that $100,000 loss is going to save you 37% if you're in the top bracket. So you can see how big of a delta that is. And the bigger the gain is, the more this impacts you positively. So it's a dual benefit. So when you're thinking about exiting real estate, you have a lot of different options on how to exit cleanly and efficiently. The worst thing you could do is sell the property and then contact your CPA and say, I sold this property. How can I save taxes? Because at that point, a lot of times it's too late. You want to have a plan. If you know you're going to sell or you want to sell, never too early to start planning for that. Because some of these things, especially when you're moving real estate, it can take a long time. It might not be quick. It's not like selling a stock. So you definitely want to plan ahead. But yeah, it's extremely efficient. On the real estate, on the acquisition is very beneficial and tax advantageous. While you hold it, it's tax advantageous, and when you exit, it can be tax advantageous. So it's a a generational wealth building tool, and also a tax saving tool as well. It's why we lead with that.
I love it. And so I guess if all of you are listening, you can realize that one of the most important things you can do for yourself for 2025 and more importantly for 2026 is to really work with a very reputable firm who knows what they're doing and start planning ahead of time, right? And this includes exits, it includes strategy for acquisitions, for all of that. And so again, if anyone wants to work with Nick and his team, that's generationalwealthmd.com/CPA in lowercase. Nick, I want to give you time to wrap up any other year-end tax strategies that were top of mind for you as you came in. And then like the last piece, I want to talk about discounted Roth conversions, which is what I want to touch upon. And we won't have time to go in depth into it. But those of you thinking about Roth conversions, and we've had a lot of investors call us and say, hey, I'm considering Roth conversions. And, does the new opportunity allow me to do that? And so I want to touch upon that. But
Sure.
as we wrap up, anything else that is top of mind for you that people can think about when they think about year-end strategies?
Yeah, so I can throw one more out there as we're close to year end, and this one might be a little bit out of the box. It strays a little bit away from real estate, but it's something to put on everybody's radar, and you can look into it. And like Param was saying, if you have any kind of any questions or want to learn more about it, you can feel free to reach out anytime. I'm happy to provide more detail because it's very complex, but it's an investment in oil and gas. And some of you may have come across that or heard about that, and I'd like to talk a little bit about tax benefits. Specifically, it's a working interest in oil and gas. There are different types of investments in oil and gas, but specifically, you want a working interest in oil and gas, not a royalty interest or any other type of investment. Working interest is what gives you the tax benefits we're going to talk about. So what that basically means is that you're investing in a fund similar to like investing in a real estate syndication. You're investing in a fund that drills for oil. So there are inherent risks with that. It's not a tangible asset that you can see and touch like a house. It is an operation, and the operation could fail. These are expensive operations. They're risky operations, not only from like a liability risk, they're dangerous, but also physically for the workers who are there, but also it's unpredictable. You could drill into wells and they could be empty or not produce as much as you were expecting, and there could be additional capital calls, and it's more unpredictable, more risky of an investment. The biggest risk, though, however, is that in order to get the tax benefit that I'm going to mention here, you have to invest in these. Well, you don't have to, but to make it non-passive, you have to invest in the activity or the fund in your own name. You can't use an entity that limits your liability. You can't use an LLC, can't use an LP, can't use any kind of entity that would limit you. So that exposure means that if you invested $100,000 and there was a capital call because there were major expense overruns or there was some litigation because one of the workers got hurt on site or whatever the case might be, you could be liable for more than your initial investment. That's what that means. So there's a risk. But the benefit of these investments is that it's the only area in the tax code that's going to provide a significant tax benefit and be non-passive without you having to materially participate. So you could make this investment tomorrow and get a huge non-passive write-off to offset your W-2 or any other non-passive income without having to spend any more time on it. Extremely advantageous because we usually see on average about 70 to 100% of your initial investment passing through to you on the K1 as a loss in that first year. So if you invest 100K, I wouldn't be surprised to see your K1 show 70 to 100K loss that you can deduct against your W-2 without having to materially participate. That doesn't happen anywhere else. So major tax benefit with trade-off that it's more risky. But what we have seen a lot of these funds do and a lot of these partnerships do is while you're initially investing as a GP with exposure, after a year, they'll convert you to LP and then you can switch your interest to an LLC and protect yourself. And at that point, you'll have extracted most of the upfront benefit. So you can essentially leave yourself exposed for about a year and then transition into a more protected investment that would be then passive to you. So when you're asking about year-end strategies, that's a really good one to keep in your back pocket. Of course, it requires due diligence and make sure that you work with somebody reputable who's been doing this. There's a lot of marketing materials out there. It's easy to slap these tax benefits on a brochure and pass it out. So make sure that you know who you're getting into bed with and who's doing these investments, that they've been there before, and that they have a portfolio history that demonstrates that they're successful. But the tax benefits are outstanding. So that's another one for year end. And just to touch on the Roth conversions, like you were saying, that's kind of like
Nick, if I could just take a second
Sure.
to add my 2 cents over there. And so
Please.
oil and gas, we've done our due diligence for quite some time on it, and like Nick said, it's a trade-off, right? You really need to understand the risk over there. The tax benefits are exceptional, but make sure you're looking at the track record of the operators. What is the stage? Are there oil producing wells in there? Know that there's volatility both with the price of oil and with the cost of any. There could be unexpected production costs, and that add to the volatility in terms of returns. Liability was something Nick touched upon, so make sure you understand that when you go in. And then know that every dollar return, and Nick, correct me if I'm wrong, every dollar return does get taxed at your marginal tax bracket on the active side. And so factor that in terms of overall returns, because if you see someone saying 1.7 to 2.5x returns over 7 years, know that those returns will get taxed at your marginal tax bracket on the active side. So I just wanted to throw that out there before we move on to the discount Roth conversions.
Yeah, that's exactly right. So these are ordinary. This is ordinary income, and on the saving side and on the income side. So when that comes back around, there is recapture here too. So you want to be aware of, just like the syndication, you want to be aware of what the sponsor is doing and your exit timeline, and you want to plan for that. It's a great way to lock in some last minute tax benefit, but we don't want to turn a blind eye to what happens after that either, of course. So yeah, always planning involved. But yeah, just to build on that, as far as the Roth conversion goes, is that's something that's like the part B of the conversation that we have. First, part A is how do we reduce your taxes?
Yeah.
Part B is, well, now that your taxes are reduced, what do we want to do? Do you want to save those tax savings and reinvest those into a new investment? Or do you want to maybe convert some retirement? And that's one of the conversations that we have too, is do you want to convert some of your pre-tax retirement into a Roth? Because that conversion is taxable, but once you get it into Roth, then it earns money tax-free. So it is beneficial to do in lower income years. And when you're thinking about Roth conversions, what you mentioned, discounted Roth conversions, that can take it like a step further. That's like a Roth conversion on steroids, basically. So the discounted Roth, what a discounted Roth conversion means, it's exactly what it sounds like. It discounts the value of your pre-tax retirement vehicle before you convert it. That way the value of the conversion is lower than it would have been if you didn't do the discounted process, saving you some tax on the conversion. So basically there's discounts that you can apply when valuing assets in your retirement account based on lack of marketability, meaning it's not easily tradable. It's not like a Google share where anybody who's selling that, there's an equal number of people or more wanting to buy it. There's non-public assets within your investment. And that could be an investment in a business, could be an investment in real estate, could be anything that's not publicly traded that may not be as marketable. So there's a couple different discounts you can apply, but basically you would need a really strong source of truth for that discounted value, whether it's an appraisal or a CVA, or something to solidify that the value is decreased or the value is what it is at the time of the conversion. And then you perform the conversion once you have that valuation, and that's what dictates your taxable income, the value at conversion. So you could be strategic with that too, depending on what's held in your IRA. So if you're holding non-public assets that are not like stocks, bonds, or ETFs in your self-directed IRA or your pre-tax IRA, it's worth the conversation to see if it's possible and what the discount might be and how much that might be able to save you.
That's awesome. I feel like we could go on, and I told you we'd probably do 20 to 30 minutes, Nick, and we're at 40 minutes. So we'll wrap it up at this point. But I hope this was super valuable for all of you. And I think when you were talking about year-end tax memos, I think the most important thing you can do is to really talk to someone about your personal situation, start planning for next year, and get those tax preparation services engagement locked in. So you're working with a really strong team. And so if you're looking to work with Nick and his team, guys, please go to generationalwealthmd.com/CPA in lowercase, and they do a free introductory call and they get to understand your situation, and that's a good place to get started. If you're thinking, okay, I want to lock in some passive losses before the end of the year, right? You have a few weeks. We still have the last opportunity of the year. That would be gwcapital.com/MHP fund, the number one in lowercase. And that's going to allow you to, take a look at the webinar, book a call with the team. We're getting really close to the soft commit deadline. So if you want to take action, lock your non-binding spot in and then hop on a call with the team. So you can learn more about that opportunity and see if it's a great fit for you. I mean, again, that's one where we have significantly higher depreciation losses than we ever have had. High cash flow day one, like Nick and I have been talking about, that is going to be tax deferred. So you don't have to pay taxes on that as it hits your bank account, and really strong IRR numbers. So take a look at that. And if you're learning for next year to see how, a real estate professional status or short-term rentals can work, then get on the wait list. That's generationalwealthmd.com/waitlist in lowercase to learn more when we do open up the next cohort for the coaching program. But with that said, Nick, thank you so much for doing this. Again, you're such a wealth of information. I keep learning new stuff every time I talk to you. Thank you.
Thank you so much for having me. Yeah, I know it's a lot to fit in a short window, so I hope it was valuable. You guys got some value out of it, but always happy to talk anytime. I'm happy to do it.